Happy 2026. I can still say that 16 days in. Have you kept your resolution yet? Are you feeling like it's a new year, new you? Because the economy is still the same same thing. Inflation is hot, and so are precious metals. My name is Dan Weir. I'm the marketing director for Sonoma Wealth Advisors, or Firmata family of brands. And you're about to go on the markets this week looking at, yes, inflation hotter than expected, and gold and silver just don't seem to quit. Spoiler alert, one of the things I just mentioned is the best performing asset of this decade, shockingly. The not so shocking advantage of Roths over traditionals. And we'll get Daren's thoughts on why the politicians and the market right now are a little bit like a late night jewelry commercial. Let's get started.
The stock market, the economy, your money. What's the latest and what could be next? Find out now with Firmata on the markets. Straightforward financial market updates for the brands of Firmata Advisors, Sonoma Wealth Advisors, Firmata 401k, and Firmata Tax. On the markets starts now.
Let's bring them onto the show. They are your managing principals of Sonoma Wealth Advisors, the Firmata family of brands, Daren, Blonski, Chris Sipes. Guys, welcome to the show.
What's going on? Happy Friday.
And now, before we get into the show, I'm just going to start here because, yes, Daren, the NFL playoffs are going on. Chris's team is no longer in the playoffs of college football.
Was that Ohio State?
But my team is still playing. And I'm watching a lot of football.
They're playing the Eagles this weekend. I don't know, man. Not for long. They have
Seahawks.
That's right.
Yeah.
They've already beat the Eagles.
Wrong bird. If you've watched any football in the past year, you've seen these commercials, and because betting legal now in certain states. And guys, the one that just caught my eye this past weekend was there's a couple companies out there. One of them is DraftKings, and they have this commercial that says "Ride the upside," right? And also that if you spend $5 with them, you get 50. And, last week we were talking about how financial services is just held to a different standard when it comes to advertising. And I saw this commercial and I was just like, could you imagine if you were trying to advertise investments, Chris, by saying, ride the upside?
Yeah.
Just stunning how some of these things are. It just made me laugh at the juxtaposition.
Absolutely. Well, if you go to Kalshi, another betting site, it looks like, I believe Seattle is favored to win the Super Bowl, right? So hopefully the Niners can rid them of that bet.
Just funny. The standards for different industries in finance, because I think betting is technically finance at this point, made me laugh. Chris, what do you got for our first meme?
All right, we've got the Dilbert comic this week, Lessons in Investing, and it says, you should buy a stock whenever the chart looks like a squirrel sitting on a clown's shoulder. And the guy says, that's called technical analysis with air quotes. And the other guy says, well, I'm not going to do that. And the guy drinks his coffee and says, good, because it doesn't work if everyone does it. a little finance humor. Scott Adams passed away this week, unfortunately, who was the creator of Dilbert. So anytime I see financial humor in the mainstream, try to capture it. So that was a funny one. I found it funny.
Daren, before we jump into the deck here, did you want to talk about the Diamond Center? Or you want to do that later in the show?
I can just do it later in my show. I'll do it in my slot.
All right.
All right, so it's that time of year again. People are starting to work on their taxes, which we've put out some information for clients so that you know when to look for those documents, where to look for them. I just got one of my emails today that some documents were ready, and it's also that time of year to consider funding a Roth. And this from Peter Maluk at Creative Planning, showing the power of tax-free compounding. He says, same contributions, same returns, but nearly $900,000 more with a Roth IRA by age 65. Time and taxes matter more than most people realize. And so that's one of the reasons why people, you know, are interested in a Roth as a tax shelter in the future. And the limits did go up a bit this year. So if you have been contributing in the past, it's a good time to check and see what the new limits are for this year, so that you can make sure to max that out if you can this by the April of next year. So you still have time to fund 25 up until tax time, and then 26 contributions are also open now. All right. So a lot of talk with AI and how this is going to be a game changer for us. I thought this was really cool, showing GDP back in the 1700s. And look at firewood as a share of US GDP, 1774 to 1920. And obviously that is pretty much insignificant portion of GDP now. But it's funny that back in the nation's founding, it was roughly 28% of the US's GDP was firewood. So a little more optimistic this week. I had a meeting with Goldman Sachs, and they did some research on this, and they feel that, and these numbers are rough, but something like, in their view, something like 7% of jobs will be completely eliminated. Somewhere in the 60% range is going to be a case where people are just using AI to be better at their jobs. And then they felt a little over 30%, around 30% or a little bit over, was going to be kind of unaffected by AI, which, I'm sure they've got smarter folks than I at Goldman. So hopefully they're correct, and this isn't just a dystopian future for all of us.
Mind you, Chris, did you ever watch the podcast, The Diary of the CEO?
Yes.
Right, can I cut you off there? So he interviewed Tony Robbins this week. Did you watch that clip I sent, where Tony Robbins is literally in tears about how much pain AI is going to create for the world?
Yeah.
And he's in tears about the idea that it's going to destroy people's sense of meaning. I thought that was just really interesting that he was so.
Yeah. It is interesting, and it's kind of the defining moment of this time period for sure. But, if we're going to take any lessons from history, it's that things are going to change in the economy, and hopefully, the arc has been up. I think, the average person's life today is magnitudes better than they would have been in the late 1700s, when firewood was a massive part of GDP. So hopefully that is the continued upward trajectory of humanity. And, like Goldman said, hey, look, there's going to be jobs created that we can't even think of right now. When we met with Capital Group, and they said something like, nobody knew what a yoga instructor was 50 years ago. Right. So there is some truth to that. And, I think we got to hope for the best, right? Plan for the worst and hope for the best when it comes to,
I think a good example, Chris,
revolution.
I think a good example to think about, if you want to try to think about it in a positive way, is a toll taker on the Golden Gate Bridge. Before the car existed and before the bridge existed, that wasn't a job. And then for 100 years or whatever it was, 80 years, that was a job. And now it's not a job. So that was a job that was replaced by AI.
Yeah.
Not sure that was necessarily the best job for anybody. Maybe it was for the people who had that job. Maybe they enjoyed it. There was some human interaction, which was cool. But that is a job that got replaced by AI before we were even talking about AI. So you're right. It's the ball keeps bouncing down the hill.
I don't know if your kids do this, but my kids video themselves doing everything, like brushing their teeth. And, it's because they want to be a YouTuber. And again, thinking back at when I was a kid, that wasn't a thing, and now millions of kids all over the planet want to be a YouTuber. So, yeah. So anyway, sentiment indicator, we're getting close to that 50% bullishness in the markets. So interesting increase in bullishness over the past week. Bearishness seems to have faded to start off the year. It seems like investors are pretty optimistic now. CNN Fear and Greed Index is agreeing with that. It's up in the 63 range, which was kind of in the middle of greed. So not an extreme greed yet, but just in the middle. That's up from 53 neutral 1 week ago. And then we've got Bitcoin at 49 neutral off its lows at 27 fear. Of course, we saw a big jump in the Bitcoin price over the last week. So that sentiment is definitely following price in all of those markets. But overall, investors feeling pretty cheery when it comes to the sentiment. And it looks like the corporate bond spreads would agree with that. Now, a spread in the bond market is simply, the difference between a treasury, which is considered, a lower risk because the government can just print money to pay you back. So there doesn't seem to be a credit risk on treasuries, although I'm sure some people would argue that. However, the spread is what an investor is willing to accept over and above the yield of treasuries to take the risk of buying a corporate bond. Now, there are some that would say, well, look, some corporations are in a much better financial position than the US government, so that's not surprising. But spreads are very tight, meaning there's not much of a difference between buying a corporate bond and a US Treasury. In fact, they're at lows that we haven't seen since 2007. So this is an indicator of comfort, in terms of investors not feeling any panic. You can see that when there is panic, that's the spikes on this chart. And so people demand more of a premium on their bonds. And you'll notice there during the inflation spike that we saw, there was also a premium, and that is around the inflation numbers, which is the title of this week's program is around inflation. So if fixed income investors or bond investors are worried about inflation, they typically want a higher rate of return, because remember, most people that buy bonds are buying them for a long term. And if inflation is going to come in and make their money worth less, they're going to require a higher return in order to take the risk of lending that money out. So not a whole lot of worry in the bond market as illustrated by spreads at the moment. Now, gold, on the flip side of that, has been the best performer so far of the 2020s. This from Bank of America, and showing gold versus some of the other asset classes. Large cap would be referring to U.S. large companies. Then you've got the growth and value flavors within large cap. You've got copper. Copper and commodities much higher on this list than I would have guessed, along with real estate. Now, those are all the types of assets that tend to do well. Commodities tend to do well in inflationary environments and in higher growth environments. So if you get either higher growth and there's more demand for those commodities, or you just get higher inflation where the price of those commodities is higher, you tend to see a higher performance. And that's something that people are always concerned about in the investment world is, are we going to get a return of inflation? How much is inflation a factor in the outlook moving forward? And at least so far, we're halfway through the 2020s here. It's interesting to see some of the inflationary assets that are benefited by inflation performing, and the ones that are not performing aka government and corporate bonds, inflation is a real kryptonite to bonds, because you're getting a fixed income. So if those prices go higher, it's really bad for bonds. So the way the asset classes are showing is that we've had elevated inflation. Like if somebody just showed you this chart and said, what do we have higher inflation or lower inflation? You probably would go with higher inflation.
Daren, you've been a quote gold bug. You've been into gold for a long time. And so when you see this chart and you say that gold is the best performing asset class of the 2020s, I think there's part of us that just goes like, well, of course it's gold. When it's because it is, therefore I can come up with a narrative for it. Can you remember a time when that would have been nonsensical and gold was a dog?
Well, I think there's always this debate going on, right, between quote unquote synthetic assets, which arguably is stocks, arguably is bonds, arguably is Bitcoin, versus gold and silver, hard physical things, and through the history of time of the human race, gold has been looked at as valuable because it's difficult to get out of the ground. Silver less so. Silver's had a pretty crazy run lately, but I don't. To me, it's not shocking considering that we have everything going on internationally that we do, and there's certainly a shifting of world powers and things changing under our feet as it relates to power in the world. As we move to a multipolar world, it makes sense that governments, businesses, and individuals are acquiring more gold and silver as a way to maintain, a sense of value, right? Because at some point, the dollar, and we've been saying this for years, is not going to be worth what it is, right? It's losing value. We're printing too much of it. We can't stop. And so we have to either engineer some type of off-ramp using crypto or something like that, or we've got to find a way to shore up the dollar. And I think that's why you're seeing this kind of tough man mentality around the world. But then what that does is, they had a government bond auction this week and no one showed up but the Fed to buy their own debt, basically. Where back in the day, China was buying it hand over fist, and so were the other countries, but they're not anymore. They're buying gold hand over fist and silver hand over fist.
Okay, so inflation matters for many reasons, like we were just talking about with societal tensions. When you have higher inflation, that's very destabilizing. Just like if you get deflation, that was what happened during the Great Depression. That's also very destabilizing. So that's why the Fed and economic folks really focus on inflation and trying to keep it stable and trying to keep it in a moderate range. So we got the inflation number this week on the 13th, and it came in at 2.71, which is, as you can see on this 5-year chart, we're just kind of going sideways on the inflation front. I wouldn't say it's going up. I wouldn't say it's going down. It's kind of sideways. And so that will play into the cost of money, because going back to fixed income investors, they have to try to figure out like what are those future payments worth to me, right? I'm going to be receiving this income for 15 years, 20 years, 30 years. If I'm going to buy a long-term government bond, is that money going to be worth enough for me to buy that payment stream? And inflation is a big part of that. So the cost of money has an inflation factor built into it, because investors, are constantly contemplating that. So the Fed has an impact on the cost of money in the short-term interest rates, of course, but ultimately the market is who prices the cost of money, and a big factor in the price of money in the public's eye is inflation. And that's why it's so important. If we look at some of the factors affecting inflation, one of the largest inputs to the CPI reading is home costs, and they measure that through owner's equivalent rent, which is a kind of a weird measurement, but essentially they're trying to capture the cost of housing. And some on the good news front, I guess if you're looking at it from an inflation standpoint, is this from Kevin Gordon at Schwab. He says the median sale price of a new single-family home fell to $392,300 in October, which was the lowest since July of 21. So I think, looking at this chart, it looks like that it's in a downtrend. It's not falling off a cliff. It's not crashing, but there is a downtrend in housing costs. Now, eventually that will funnel through to inflation. And given that it's roughly 30% of the CPI reading, it should have an impact on those inflation numbers. When we look at the 2-year rates, which is, the market's kind of assumption of short-term interest rates, that is the dark blue line here versus the Fed funds rate. And you can see that the Fed funds typically kind of follows that 2-year treasury rate. There's not much of a spread at this point, 3.75 on the Fed versus 3.5 on the 2-year. And the 2 years were up today, so that spread is even tighter at this point. So the market is saying, hey, the Fed is not that far off in terms of their price of money. Maybe they're a little bit tight. When that gray line is above the blue line, that would be considered a tighter monetary policy. When it's below, the Fed would be considered too loose. So you can see the whole time that inflation was taking off in 2022, the Fed was behind the 8 ball in terms of hiking. Even though they were hiking very aggressively, according to the market, they were a little bit behind and they were a little too loose during that period. Then they got too tight and caught up. So right now, though, the spreads are pretty tight. And when you look at the expectations for the rates at the next Fed meeting at the end of January on the 28th, right now the probabilities are 95% that the Fed rate stays where it is today. And, I think those probabilities also increased not only from the CPI on Tuesday or Wednesday, whenever that came out, that inflation was a little sticky, but also with the indictment of the Fed chair. Now that kind of puts Powell in a position of like, he's got to show that he's not just lowering rates just to appease the White House. He's got to show that the Fed is still independent. And so, to me, it was sort of like shooting yourself in the foot if you want lower interest rates to kind of put Chairman Powell in that position. It's sort of like, well, now, it less likely. I could be wrong about that, but that's my perception of what was happening with that whole indictment. So, and then of course, Trump came out this week and said, "Oh, I'm not getting rid of Powell. It's not a big deal." So who knows? Who knows what's going on there? But it looks like Kevin Warsh is going to be the next Fed chair based on the betting markets. That probability increased quite a bit this week when Trump mentioned that he would like to keep Hassett in the White House position that he's in now. So Warsh is looking to be the next Fed chair the way things are lining up today. And at least so far, that has increased interest rates. So if we look at what interest rates have done really since November on the 10-year, they've been on the upward trajectory, and now they're kind of above their moving averages, which I'm sure we'll get into when we look at the candlesticks. But the market is pricing in a little bit higher interest rates on the long end. And so that could be assuming higher inflation. It could be assuming, further deterioration in the U.S. Financial position. Who knows what it's factoring in, all these areas. But that is the 10-year is the number that affects mortgage rates. It affects credit card rates. It's kind of the middle of the curve on the treasury curve. And most spreads on credit are based on the 10-year treasury, roughly. And so if you want lower interest rates, you do not want to see that 10-year treasury rate going higher. You want to see that going lower. Okay, switching gears a little bit to the US dollar. When the US dollar is losing strength relative to other currencies, that happens to be good for foreign market equities. And this is a great chart from the JP Morgan Guide to the Markets. They just released the new one. And it shows the cycle of developed markets. That's what DM stands for here. Developed markets, ex-US, outperformance in the US dollar. So those periods that are in gray there are periods when the US dollar is declining relative to other currencies. And then you can see the blue, or sorry, the purple is where the foreign stocks outperform. And we've been in a very, very long period of time where the US has outperformed. You can see really since the great financial crisis, the US has outperformed consistently since then. But we just started a weaker dollar regime, going into 24. And so, so far at least, the foreign stocks have been performing very well. And if this cycle continues as it has in the past, you could see continued outperformance based on currency changes. Global equity markets, this also from the JP Morgan Guide to the Markets. And the one to focus on is on the right side where it shows the share of global market capitalization, which just means what portion of, if you were to add up the value of all the stocks in the world, what portion of that is related to which country, the home country domicile. And this goes back to 1987. And you can see that Japan previously was a little over 40% of the global market cap, while the US was at 30, which is kind of mind-blowing based on today's assumption of how the world works. I mean, looking back to the late 80s and thinking that Japan's stock market was worth more than the US stock market and the global markets is kind of hard to wrap your head around using today's perspective. And the US now makes up a larger portion of the market capitalization of the world than any country in the history, known financial history has made up. And these things do change. Look at what happened with Japan. And I'm not saying this is definitely going to happen with the US. Japan's financial valuation metrics were astronomical, almost twice what we reached in the 1999 dot-com bubble. Our CAPE ratio, or cyclically adjusted price to earnings ratio, in the US during the dot-com bubble was a little over 40. Well, Japan's reached around 100 in the 1980s. So they were very, very highly valued. But since then, they've really dropped off. They went from over 40% of the global market cap to 5% in modern day, which is really, really wild. So these things can change. They can also get very crazy. Think about it. What if the US went from a CAPE of around 40, where we're at today, to 100? Can you imagine? Anything can happen, right? People's sentiment can get twisted in all kinds of ways, and it only makes sense in hindsight. So that's why valuations are a horrible timing tool. You just never know, right? But you can look at it from a probability standpoint and go, ooh, what's the upside downside here? Are we investing, or are we being speculative and just assuming it's going to go up, based on what everybody else thinks? So when you look at the, there we go. Returns over the last year, are we seeing a shift in the force, right? Is something changing? This is over the last year. You can see the emerging markets were the top performer. Then you had developed markets second, And then look at the Russell 2000, the small cap stocks that have gone nowhere for 4.5 or 5 years, just eking out over and above the U.S. large caps and the S&P 500 over this past week. And so far, year to date, the small caps are just trouncing everything else. What's that related to? Who knows? But there's definitely a trend in the small caps breaking out. And now we've got a year's worth of data here to kind of back that. So we might be seeing a little shift in market trends moving forward. And that's largely driven by earnings. And you look at over the long haul, stock prices tend to follow earnings. And this from Bank of America showing the small cap earnings growth is now positive, and it's expected to eclipse large cap earnings growth in 2026. So small caps being that dark blue, mid caps being the medium blue, and then large caps in orange. So it's been an all large cap story for a long period of time. You can see the breakout of AI there in the third quarter of 2023 that really set the market off its lows and really took off. But now the small and mid-size companies are starting to catch up when it comes to the earnings, and they're projected to continue that here in 26. So possibly some opportunities in the small and medium companies moving forward.
Chris, did you say there's a disturbance in the force? Is that what I heard you say about a minute ago?
I was just trying to make sure you're still awake, Dan.
Did I hear you mention Disney? What are you talking about?
We're gonna go Star Wars. We can get going here. Daren, I want to see some candlesticks. I want to see why the market is telling me everything is just fine.
Candlesticks?
Just fine.
Okay.
Just fine. What do you want? What do you want from the market? We'll give it to you.
That's right. Well, this week, it's becoming very clear that the politicians are getting anxious about the up and coming midterm elections because we're seeing lots of things that are, I think, playing to the voter base, and it feels like today with the announcement of the supposed, I don't think they've announced it yet, but supposedly they're going to announce the ability to use your 401k for first-time home buyers, which I have a lot of hesitation about. I think that's probably problematic for most people long-term to be doing that. And I would argue perhaps you can't afford that home if you have to invade your 401k. If you're betting that the market's going to go to the moon forever in the stock market and in the real estate market, and invading your 401k to buy a house, and maybe I can make the argument if you're buying a home, not a house, but if you're buying a house with your 401k, I don't know if I'm going that direction. So anyway, lots going on out there, and it just feels like it's one thing after another. And so the thought that came to me was this commercial from the 80s where it was this guy in the Diamond District, and it's just this commercial that Dan has up, or a screenshot of it.
So this was, if you're from the Bay Area, if you grew up here in the 80s and into the 90s, and you watched any kind of local television, this commercial was everywhere. His name is Paul. The company was the Diamond Center. And it's just a really funny commercial where he's just sort of telling you like, well, you can do it. It's very encouraging. It's like, just get in here, you know? And so Daren was telling me, he's like, that's what it feels like, the politicians are doing right now because, midterms are coming up.
Yeah, and so you're going to start seeing this kind of play to different populations, right? So if Trump's running around in Minnesota locking people up, like, he's got to figure out, okay, well, if I'm going to alienate all those people, then I got to work on getting this people in the bank for me for the midterms. To his point, I think earlier this week, he said, if we lose Congress, then I'm going to get beached. And then I think he also said this week that maybe we should, he made some comment in such a Trumpish way of like, maybe we shouldn't even have midterm elections. Which, okay, I guess we're at wartime like Zelensky now. We're not going to have it. But rather interesting. Lots of sometimes it's hard to know what to take serious and what not to take serious. Like, is this guy for real or not? So what I thought I would talk about first, because I did talk about this last week, and that's the Supreme Court ruling in favor of Trump tariffs and why that is such a important thing to watch. And Chris and I had some discussion last week about whether or not we felt like the Trump tariffs being rebated back to everyone was priced into the market. And I have not had a chance to watch the Congress or the Supreme Court discussion yet, but apparently there was some discussion earlier today. And after that, you saw that the likelihood of the Supreme Court ruling in favor of Trump tariffs actually went up. It was down at 20%. It worked its way up. So that's interesting. And then I think Trump came out and said, yeah, they're going to be in favor of me. And you can see that jump right here at about 1:40 p.m. Today. So good news, bad news, I don't know. I guess that's probably up to your political flavor, but interesting nonetheless, and I think important economically for us to pay attention to. So this is Polymarket. For those who don't know, Polymarket is you can go on and bet on whether or not you think things are happening. We're actually seeing a lot of really interesting, and I don't know if it's even considered insider trading, but there's some people speculating that people inside the government that have certain insights on things that are going to happen or not happen, and putting massive bets on in Polymarket. I don't know if the SEC and regulators are going to have to come after Polymarket now, or how that works. But nonetheless, since they're going to get rid of the politicians' abilities to insider trade, maybe they're going to start doing Polymarket instead.
Yeah, it's weird to think because it's not technically a security, right? But it's also a way people can make a lot of money. So interesting. And also, I guess if you are someone who bets in this, and I personally am not, I'm not interested in it. I've never have been. I don't even like. I don't like any game of chance like that. That's like, I think I got burned, Dan, in college. Betting on the Buckeyes and the Browns too much.
Oh man! But you're betting on the Browns.
I'm
sorry.
I guess I learned my lesson at an early age, and I'm thankful for that. But yeah, it's interesting because if you are betting in there, know that you're betting against people with insider information that are probably going to take your money. So
that's kind of what I was trying to say at the start of the episode, which is that, I mean, the betting markets beyond just sports are now its own stock market unto itself. So we've got all these massive regulations on, and I think they're appropriate, on how you can advertise and communicate what that market is, right? But then over in the betting markets, it's like, we can say whatever we want. I mean, it's like, it seems like perhaps there should be some more, maybe someone should look at that, is what I'm saying.
Dan, I just want to let you know that the 49ers have a 26% chance of winning on the betting markets.
Yeah.
I know.
Well, you know what they do? They put that purposely low because they're trying to attract bets. So actually that means they have a good chance because they're trying to move the line.
Sure, buddy. Sure. So, but anyway, it's kind of interesting. And I think those who've watched the show for a long time know that Chris and I have used these pretty religiously when it comes to trying to figure out who the next presidential winner will be, and
use them by looking at them, not participating.
Yeah, we're not betting on them. Yeah, just to be clear, but yeah, just trying to see because really at the end of the day, the poly market is a function of the mass brain and what the brain thinks, right? And so all the humans with their compiled opinion, right? And the more participants in that, the more accurate it's going to be, or likely to be. But what you'll see is that it will adjust in real time to different things. So whatever your flavor is, I mean, they even got a whole category of what Trump's going to do. Man, talk about a volatile betting market. But it is interesting to kind of inform your thoughts about what's really going on versus reading your slant of media, right? And what the media says to you based upon your own personalized echo chamber that we all have. Nowadays, the way that the search engines work, the way that the LLMs work with the AI, Like it becomes this massive echo chamber, which, by the way, I saw a headline today that ChatGPT is now going to offer. They're going to start doing advertising on our ChatGPTs. And I guess be careful what you put in ChatGPT because they're going to try and sell you something that's
Yeah,
related.
I wonder if it's going to be subtle. Like the answer that you get back is like, well, you might try a Coca-Cola. Like,
Yeah.
the best remedy for that cut is to pour some Coca-Cola on it.
Speaking of Coca-Cola, did you see that so Coke doesn't have a patent, I think it would be, on their formula, and someone figured it out like this.
No way.
Yeah, they figured it out.
That can't be real. That sounds like
they purposely don't. I do know they don't have a patent because in order to patent, that would mean that they would have to share the recipe. So the recipe is itself super hidden.
Yes, that's it. They ignored it. So there was a YouTuber. So a YouTuber, here it is. YouTuber Lab Coats has claimed to have cracked Coca-Cola's 139-year-old secret to Coca-Cola. But what was so crazy about it is the ingredients in it were like wild. I mean, it was like lemon drops and all these like oils. Let's see if it lists it down here, but it was really pretty fascinating.
Well, it began as a medical tonic. I mean, both Coke and Pepsi began as like the 1900s equivalent of like wellness at that time.
I really hope Coke doesn't come after us for this, but here is apparently the Coca-Cola recipe that this guy figured out. But I just thought it was interesting. Like, look at all these lists of oils. Like, I had no idea that when I drank a Coke, there was tea tree oil. I mean, that's pretty amazing.
Going back to the YouTube thing, I should also mention I do not let my kids put their videos on YouTube. They just video and take up all my Apple iCloud space with it. But I just popped in my head. People are like, "You let your kids put their videos of them brushing their teeth on YouTube?" No, I do not.
Well, Chris will use it for the documentary. All right, that'll be behind the scenes footage for their documentary.
Yes, absolutely.
Oh gosh. Okay, so let's take a look at the S&P 500 for the week. For those who are new with us and haven't spent much time with us on the show, so level set, the S&P 500 is the largest 500 U.S.-based stocks. It's generally what people think of when they think of the whole market or the Dow Jones, which is only 30 stocks, but pretty hard to think of that as the whole market nowadays. So the S&P 500, this is what's called a cap-weighted look or heat map of the S&P 500. The big squares represent bigger companies, right? Last year, we talked a lot about Microsoft, NVIDIA, Apple, Amazon, Tesla, Google, and Meta being these big dogs growing and growing and growing and taking up huge portions of the overall index. And you can see they still are very large. I will just point out the consumer defensive boxes are getting bigger. So from a visualization standpoint, what does that mean? And yes, Coca-Cola is considered consumer defensive, but I think I haven't seen the stock this week, but I imagine it probably impacted it some when some YouTuber hacked its recipe. But I've been watching this Walmart one box grow, which I think is interesting. And so we're starting to see these rotations happen. What do I mean by rotations? Less the money's piling into these AI goddess stocks and starting to push into things like consumer defensive, industrials, energy. So I think that's interesting. Visa getting clobbered this week because Trump last Friday says, you guys all need to only charge 10% on your credit cards. I just wonder, like, if Trump thinks about, if I piss off enough people, and like if he's got like in his office somewhere, like, okay, I've made the oil lobby mad, and now I've made the financial credit card lobby mad, and like at some point, if you just make enough people mad, like you're gonna lose. And I think that's what you're seeing with, you got a friend in the diamond business where it's like, okay, I've made a lot of people mad, but I'm going to tell them they can use their 401ks to buy houses they can't afford. Or how about put crypto in your 401k? Because that's a great idea.
Daren, we call that ready, fire, aim.
Ready, fire, aim. Yes, yeah. I think there is a lot of ready, fire, aim with Mr. Trump. But I thought your point earlier, Chris, was great when we were talking about it. It's like, for some reason, Trump only gets the FA in the FAFO acronym. Like, he just messes around with all these people and nothing sticks. It's just shocking. But he really pissed off Canada, by the way. Canada basically gave a massive nod to the Chinese this week, where they're going to start letting the Chinese EVs into the country, and they got rid of the tariffs on their EVs. And they're went as far to say two things that I think were really, really important, and I think will prove to be a pain in our sides for a long time. And that is, one, that something to the tune of we have successfully negotiated a deal that aligns with our basically with our best interest for a multipolar world, or the power changes, the new world order, I think was the term Carney used. So basically just kissing up to the Chinese now, which, if you don't know, Canada is the country we have the largest border with, that pretty much has nothing in between us and them. You can walk all over it, back and forth all day long. So it's problematic if these people, the Canadians and us, are not one, because we are one. We're right next to each other. That can be not a good thing. He also said that if we go and take Greenland, which Trump keeps running his mouth about Greenland, that Canada is prepared to go to war with the United States over the taking Greenland. That's a pretty good statement. So I'm like, okay, this isn't going to go well for lots of people.
I am going to laugh at that one. And I like Canada.
Well, it is from a market's perspective, though. It is a serious, like, hey, all these things are going on, and yet the market, look at this uptrend, right? It doesn't seem to matter. And I think a lot of people, including me, a lot of times are just looking at it, just questioning, like, why is that? Why is it not mattering? Why doesn't it matter? I don't know. It's an unanswered question at this point.
I think of it's just like it's a function of numb, right? I think everybody's just numb, right? Like, what is Trump going to say tonight? The market's closed. Oh, great. And how many calls do we get now from people saying, oh, Trump said this, sell my blah, 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 blah. It doesn't really happen anymore, right? No one really reacts.
That's true. Yep.
If you look at right here in February, March, this was Trump's big, like, ooh, I'm going to mess around with tariffs right here. And the market just tanks, and it's just ripped ever since. And I think a lot of people learn their lesson here. Like, I'm just not going to bother. Trump's going to run his mouth, and probably like a tenth of what he says is true. He's going to throw these grenades in the room and blow everybody up, and everyone's going to get pissed off. And after a while, if somebody just creates enough emergencies in your life, you just stop having emergencies. You just don't care anymore. And that's, I think, what the market feels. And that's kind of my vibe from it anyway. But overall, if we look at it on a weekly chart, so this is looking at the stock market from a weekly standpoint, pretty positive, right? We stayed in this green candle from last week. We tested this support level. People bought it up. That's the wicking you can see. Let's look at it on the actual, we'll look on the 4-hour chart. So each one of these candlesticks now represents the 4-hour chart. And we kind of went down, and then boom, it got bought back up. It's sitting there, and we're hanging on to this important trading line right now. So I think you can only read that as positive for the market. I don't think there's anything to say that, hey, you should just stay the course at this moment. That's not advice, because I don't know what your portfolio is like, but if it was my portfolio right now, I'd be like, just keep on keeping. Nothing really to report home about the S&P 500. Other than I think we're starting to see the rotation into defensive stocks. We're starting to see money come out of these high flyers like NVIDIA. And I think that aligns with what we're seeing in gold. Gold had on weekly, we closed an all-time weekly high in gold, just shy of 4,600 per ounce. Pretty impressive growth for gold. And also silver continuing to rip. So the silver chart right now is looking at 90. Although I heard a lot of stories from different silver producer or silver retailers and refiners that there's a lot of dislocation in the silver business now. So I see a lot of rumors of that. So then when I look and let's go to Costco. Can I buy silver at Costco? And yes, you can still buy silver at Costco. And I'm not saying you should buy silver at Costco. And this is from the Inglewood warehouse. But for $1,900, you can buy 20 PAMP bars, which are, pretty popular Swiss bars. But they're minted in the U.S. PAMP and Swiss mint in the U.S. I think like any company that wants to do well during the Trump administration just slaps on minted in the USA, built in the USA, even if like part of it's not, but whatever. And then we look at SD bullion, which is a fairly low cost one. You can see it's basically $98 for an ounce or bar of gold right now. Silver coins on Silver Eagles. These are kind of like one of the staples in the silver collector's world. They're selling for, $100 north of it. It's pretty incredible how fast silver's gone up. And I'm hearing lots of dislocation amongst the silver dealers out there. And again, because you've got nation states, companies, organizations, people grabbing it, because there's some questions about whether or not the dollar is going to remain dominant, I think, in the future. So people are looking for places to preserve their wealth. Looking at mortgage rates per Chris's discussion earlier, and I just checked this was the mortgage person, and we are hovering right around 6 on a 30-year fixed mortgage. So I confirmed these numbers a few minutes ago. And but interestingly, I didn't really think about this until I was looking at this chart earlier. We're basically where we were at in September of 2008. Which is kind of interesting, right? So, right?
Nothing spooky about that.
No, nothing at all. And the mortgage rates are like right on this support line. So, if we go lower from here, there basically has to be a good economic reason. And that's probably bad news for all of us generally economically. I'm sure the people who are not in power would love for us to hit a recession right now. And to skid into it right around the midterms. And I'm willing to bet that Trump's going to do everything he can to stimulate the economy. Because like Bill Clinton used to say, is the economy stupid? But hey. All right. Well, okay, so talk about mortgage, we talk about gold, we talk about silver, let's talk about oil. Interesting little spike early on in the week. When we thought we were going to bomb Iran for like a minute, and then I'm sure someone called and kissed up to Trump, so he decided not to bomb Iran. I don't know, but it looked like we we're going to war with Iran earlier in the week, and apparently we're not. The chart doesn't think we're not. We are right now. Tension was building in the Middle East, but now we're just back to gluttonous supplies of oil, and we did sell our first batch of oil from Venezuela. And lo and behold, Trump sold it to one of the supporters. But hey, that's politics, right? So it doesn't look like we are going to war with Iran, which I think is probably good news, maybe bad news. I don't, it's hard to say what's going on in Iran because they cut the internet off.
Daren, I produce the show, so I watch every single one. And I think for the past 3 weeks, you have not mentioned Bitcoin, and we have not looked at Bitcoin. I
was just thinking about that, Dan. I feel like I might have told you I was just going to talk about Bitcoin, but I didn't. But yeah, let's talk about Bitcoin. I think it's really
Dan, speaking of playing politics, Dan, nice one on that.
Suck up. A student, baby. A student.
Way to go.
Well, you're in luck because you're rubbing in good news, buddy. And you can see we broke out above 94,000. We held support right there at 94,000. I think we go higher in Bitcoin right now. I think the odds are the upside. Let's look at ETH, the other largest, and similar chart, but a little weaker. We didn't quite break above that area right here. Support was right in that line. So anyway,
could you go back to Bitcoin real quick, and just because I feel like there was much headline about the drop, and then it seems like we're starting to see a pretty steady support gaining, some momentum building. So what are you seeing in the chart that's showing one way or the other?
Well, Dan, first off, I just want to say welcome to Bitcoin investing, because that is the way it always is. Anytime Bitcoin crashes, all the bros jump up on Twitter and run their mouths about those stupid Bitcoin investors, and then they just sleek into the hedge. You know that meme where Simpson's like sleeking, or that GIF you can use on your phone, and he sleeks back into the hedge? Like, that's like the Bitcoin haters. They all come out and scream and yell, and it's going down, it's going to die. And then it comes back again, and it does fine. And then this is, you can see this is historically, you can see these really fast dips, right? Like here, where it's just world's ending for Bitcoin. Wow, look at those candles. That's brutal. And then you start seeing these like little moves where it works its way up, works its way up, works its way up. And you can kind of see that starting to perform here. The fact that we held this long-term support line of 85,000, I think that's pretty good news. It's just doing what Bitcoin does, and that is correcting harder and going up harder than most assets, because it has a higher volatility to it. But at this point, for a whole lot of reasons, there's so many people that own Bitcoin that will never probably sell Bitcoin. That yes, you can see on the margin prices go down, but I highly doubt that you see it come back. So if you're waiting, we have a friend out there who recently sent a note, said, I'm waiting for it to come back here, and then I'm going to buy it. And I say, you might be waiting a very long time. Good luck. But we would have to see something like this, to your point, Dan, where you have a big drop, and then we go below this long term, and then we come down. That would be, the moment where you would see a bigger correction. But I don't, it doesn't look like this consolidation pattern here looks like this consolidation pattern to me, right? Very similar, like we're finding the low and then it's going to work its way up. So I feel fairly constructive about Bitcoin at the moment. NVIDIA is like doing nothing, just trading sideways, which is important because it's the biggest in the S&P 500. So all these other stocks, all these defensive stuff doing really well, whereas all these high flyers are not doing as well. All right, well, I think we're going to leave it there. Have a wonderful weekend. It is a beautiful weekend in Northern California, so hope you get to enjoy the sun.
Thank you so much for checking out the show this week. We appreciate it. If it's your first show, if this is the first time you found us and you made it all the way this far, hey, awesome. We do this every single week. It is called On the Markets. So wherever it is, whether it's Facebook, whether it's YouTube, whether it's on Apple Podcasts or Spotify, make sure to subscribe so that way you won't miss future episodes. And also on our YouTube channel, check out our other shows and content, including another podcast called It's All Money. You can also find all of that at sonomawealth.com. We'll see everybody next week. Thanks for checking out the show. We truly appreciate it.
You're up to date with Fermata on the markets. Learn about how the Fermata Advisors family of brands can help your family and business in finance. Sonoma Wealth Advisors, a comprehensive, holistic finance solution offering financial planning, asset management, and tax planning. Take our free wealth analysis now at sonomawealth.com. Fermata 401k, business retirement solutions for small and large companies with a fiduciary commitment. Learn more at fermata401k.com. Fermata Tax, personalized tax services for yourself, your family, or your business with an emphasis on efficiency. Find out how at fermatatax.com. If you haven't already, like and subscribe to Fermata on the Markets on YouTube, Spotify, and Apple Podcasts. Fermata on the Markets features human hosts, editors, and voiceover talent. Music by Dr. Delight on Soundstripe, voiceover by Joan Alloway Nash. Thank you for listening to the very end. We appreciate diligent viewers and listeners. Firmata Advisors LLC is registered as an investment advisor with the SEC and only transacts business in states where it is properly registered or is excluded or exempt from registration requirements. This content was produced by Firmata Advisors LLC, DBA Sonoma Wealth Advisors, DBA Firmata 401k, DBA Firmata Tax. The opinions expressed by Firmata Advisors LLC on this show are their own. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Viewers and listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.